Joining us now is Goldman Sachs Asset Management Managing Director Candice Tse and Truist Co-Chief Investment Officer Keith Lerner. Candice, you're here on set with us. Welcome to the show.
Thank you so much, Morgan. Thank you, John.
I want to get your thoughts on what we've seen, not only today in the equity market and this reversal into the afternoon, but just the incredible moves we've seen in the bond market and where we go from here.
Absolutely. We've seen the 10-year hit its high since November of 2022. We've seen it come back down a little bit, but what we've also seen is the inversion of the yield curve. The 2s and the 10s had reached about 100 basis points, but we are seeing some semblance of re-steepening at this moment. On top of that, we've gotten a lot of economic data recently. We got all the labor numbers this morning. That's playing into some of the market movement. We've had the Fed raise rates by 25 basis points. We have 2Q earnings. We've had the debt downgrade. There's so many things that have led the markets to move the way they have over the course of the last couple of weeks.
All right, Keith, want to get your thoughts on this, too. Where do we go from here?
Yeah, well, great to be with you on this Friday. Our view is that this market is set to consolidate, start doing some backing and filling of these strong gains. We actually saw the market last week hit around the 4,600 for the S&P level. And what you notice is even before the news from Fitch, the market had a tough time cracking that. So we think that's a formidable near-term resistance level. We all know that August is a seasonally weaker period. So we just think, it's going to be a resting period. I will say we have to remember we were up 5 straight months. When you look historically, a year later, the market's been up by about 93% of the time. So momentum is good. But in the near term, we just think this market is stretched. Sentiment has rebounded quite a bit. And again, we think there's some backing and filling from here.
Okay. Candice, often, probably too often, we talk about bonds just for their impact on equities. But I'm beating this drum of what about bonds for bond's sake and bond funds for the folks at home? I mean, we're at this point in 2023 where you can buy bond funds for cheaper than you could a year ago. The yields are higher, and it could be that a year or two from now, people are saying, wish I had bought when I had that chance to even out my portfolio. What should people do here?
I'm on the same page with you, John. I do see the attractiveness of staying short duration. The market is very attractive at the front end of the yield curve, so it keeps a lot of investors from going out and diversifying across fixed income, particularly core fixed income. But if you look out into the market and what investors can do at this standpoint, they can be thinking about extending duration now, right? We're not telling you to sell out of your short duration because the yields are very attractive. But if you think over the long term, you can actually achieve greater coupons over the longer term while also having a secure hedge. So from that perspective, you can help with your reinvestment risk by extending duration.
Makes sense. And Keith, so okay, taking a step back to equities now, if strong results from Amazon and a just right jobs report weren't enough to take the major averages higher for the week, is that a bad sign for the markets overall?
Yeah, I think it's a sign that we have reset expectations much higher. So the bar for positive surprises is also much higher. So I think that's another indication that this market just needs to rest. I mean, we've had this big first half, stronger than pretty much anyone thought. So markets don't go in a straight line. It's often 2 steps forward, 1 step back. I think a minimum, we're going to see a correction in time and probably price. So I do think that tells us, though, that the market is somewhat heavy, especially when you think about how big, regardless of your opinion about Apple, it's 7% in the S&P, it's 27% of the S&P technology sector, and it's about 11 or 12% of the QQQ. So, that's going to have a big impact on this overall kind of top-heavy market.
Yeah, we've seen a couple strategists and economists kind of back off on recession calls. J.P. Morgan this afternoon, case in point. I just want to get your thoughts on the soft landing narrative and whether that makes sense in this market here, how to factor that versus near-term seasonal weakness, potentially.
We've had the soft landing scenario as our base case for a while. As you know, at Goldman Sachs, the scenario is a 20% probability of recession. So I think now many folks are actually agreeing that a soft landing is possible. What we found is that the Fed raised rates in July at 25 basis points. We do think they're at the tail end of this hiking cycle. And I think they've engineered a potentially nice path towards a soft landing, averting a recession. So from that perspective, we do think that this is possible, right? The private sector is much stronger than we saw during the global financial crisis. We do see inflation coming down. The labor market is still tight, as we've seen with labor numbers today. But nonetheless, I think we're on the right path towards getting inflation lower, maybe not towards the 2% this year or next year, but we're getting closer to that.